What's happening in the silver market right now is absolutely unprecedented. And if you're not paying attention to what Chinese buyers are doing, you're missing the biggest story in precious metals today. While everyone was focused on silver's wild price swings over the past few weeks, something fundamental has shifted in the market structure that could change everything about how silver trades going forward. Let me start with a number that should grab your attention. Chinese institutional buyers now account for over 50% of global daily spot silver turnover. Think about that for a second. More than half of all silver trading volume on any given day is now coming from China. This isn't retail investors buying coins or small bars. We're talking about massive institutional players with deep pockets and a very specific strategy that's reshaping the entire market. So what exactly is happening here? To understand the significance, we need to look at where we are right now. As of today, February 10th, silver is trading around $80.95 per ounce. That might sound high if you remember when silver was hovering around $25 just a couple of years ago, but here's the context you need. Just 2 weeks ago, on January 29th, silver hit an all-time record high of $121 per ounce. Then came one of the most dramatic collapses in precious metals history. On January 30th, silver lost almost 30% of its value in a single day. That was the biggest one-day drop since 1980 during the Hunt brothers silver manipulation scandal. What triggered this massive sell-off? The nomination of Kevin Warsh as Federal Reserve Chair signaled a more hawkish stance on monetary policy, which spooked markets and triggered massive liquidations in paper silver positions. Futures traders, hedge funds, and speculators all rushed for the exits at the same time, creating a cascade of selling that drove prices from $121 down to around $65 in mere hours. But here's where the Chinese buyers come into the picture and why their role is so fascinating. While Western paper markets were in complete panic mode with leveraged positions getting crushed, Chinese institutional buyers saw this as the opportunity they'd been waiting for. They didn't panic. They didn't sell. Instead, they accelerated their physical accumulation strategy. This tells us something crucial about the nature of Chinese demand. These aren't momentum traders looking to flip positions for quick profits. They're playing a much longer game, and they view silver as a strategic asset worth accumulating regardless of short-term price volatility. The fact that they now represent more than half of daily trading volume means they have enormous influence over price discovery and market dynamics. So why are Chinese buyers so aggressive in the silver market right now? There are several interconnected reasons, and understanding them gives us insight into where prices might be headed next. First, there's the macro picture. China's relationship with the US dollar has been evolving for years. While they can't completely abandon dollar-denominated assets overnight, diversifying into hard assets like silver provides a hedge against currency risk and geopolitical uncertainty. Silver, unlike gold, isn't primarily held by central banks and doesn't carry the same political visibility. It's a way to build tangible wealth outside the Western financial system. Second, industrial demand from China itself is massive and growing. China is the world's largest producer of solar panels, and solar manufacturing is one of the biggest consumers of silver globally. Each solar panel requires silver for its conductive properties, and China's commitment to renewable energy means they need a steady, reliable supply of physical silver. When you're building an industrial infrastructure that depends on silver, locking in supply at what you perceive as reasonable prices makes strategic sense, even if those prices seem high by historical standards. Third, and this is important, Chinese buyers have watched what happened in other commodity markets over the past decade. They saw what happened with rare earth elements, lithium, and other critical materials, where supply constraints drove prices significantly higher. Silver has a similar profile. It's in structural deficit, meaning more silver is consumed each year than is mined. Existing stockpiles are being drawn down. Unlike gold, which is mostly recycled and stays in the monetary system, silver gets consumed in industrial applications and disappears from the market. The timing of this Chinese buying surge is particularly significant given recent market dynamics. 1 year ahead, U.S. inflation expectations have fallen to 3.1%, which reduces the pressure on real interest rates. This makes non-yielding assets like silver more attractive from a pure investment standpoint. At the same time, the US dollar has been weakening, which makes dollar-denominated commodities like silver more appealing to foreign buyers, who are essentially getting a currency discount. There's also a geopolitical angle that can't be ignored. Japan's recent election saw Prime Minister Sanae Takaichi win by a landslide, strengthening expectations for expansionary fiscal policy in Asia's second-largest economy. When major Asian economies are pursuing policies that could devalue their currencies or increase inflation risks, precious metals become more attractive as stores of value. Now let's talk about what this means for where silver prices might go from here, because the Chinese factor changes the equation significantly. Major investment banks are weighing in with forecasts that reflect this new reality. UBS is predicting that silver could return to $100 per ounce as soon as next month before settling around $85 by year end. Goldman Sachs is more cautious, particularly compared to their outlook on gold, citing concerns about how industrial demand might respond to sustained high prices. Here's the tension in the market right now. On one side, you have this enormous Chinese institutional buying, providing a solid floor of physical demand. Physical premiums remain elevated, meaning people are willing to pay more than spot price to get actual metal in their hands. This indicates the underlying physical market is tight. On the other side, you have concerns about demand destruction. With more than 50% of silver demand linked to industrial applications, these high prices could eventually result in reduced consumption. Manufacturers might find substitutes, use less silver per unit, or delay projects that require significant silver inputs. The upcoming Chinese Lunar New Year holiday, running from February 16th through the 23rd, adds another variable. This week-long celebration typically creates a liquidity vacuum in Asian markets as traders and institutions shut down. With Chinese buyers representing such a huge portion of daily volume, their absence could lead to increased volatility or potential price weakness in the near term. But looking beyond the next few weeks, the structural factors supporting silver remain intact. The world's transition to renewable energy isn't slowing down. Electric vehicle production continues to grow, and EVs use significantly more silver than traditional cars. Artificial intelligence infrastructure requires massive data centers filled with servers, all of which use silver in various components. The supply side isn't keeping pace. Mine production is constrained, and it takes years to bring new silver mines online, even when prices are high. What makes the Chinese buying pattern so important is that it represents patient, strategic capital that's less likely to panic during volatility. Western paper markets can experience massive swings driven by leveraged speculation and algorithmic trading. But when you have institutional buyers consistently absorbing physical supply, regardless of short-term price action, it puts a floor under the market that wasn't there before. Here's what I'm watching to gauge where we go from here. First, whether Chinese buying remains consistent through the Lunar New Year period and beyond. If they pull back significantly, we could see prices drift lower as Western selling isn't fully absorbed. Second, upcoming U.S. economic data on jobs and inflation will guide Federal Reserve policy expectations. If inflation stays sticky or reaccelerates, that supports silver. If it continues falling and the Fed maintains a hawkish stance, that's a headwind. Third, watch physical premiums. If they stay elevated or increase, that confirms the physical market is tight despite whatever happens in futures trading. The bottom line is this. The silver market has fundamentally changed with Chinese institutional buyers now controlling the majority of daily trading volume. This isn't a temporary phenomenon or a speculative bubble. It reflects strategic thinking about resource security, monetary diversification, and industrial necessity. While we might see continued volatility in the short term, especially around the Chinese New Year holiday, the presence of such dominant price-insensitive buying suggests that silver's price floor is significantly higher than it was in previous cycles. Whether we're heading back toward $100 or settling into a new range around $80 to $85, one thing is clear. Ignore Chinese buyers at your own risk, because they're now the most important players in the silver market, and understanding their strategy is essential to understanding where prices go from here.